Bitcoin versus crypto. Some of these thoughts first originated sometime late last year in preparation for a presentation that I did at Adopting Bitcoin in Cape Town. Interestingly, the landscape has shifted somewhat. At the time, the only digital asset, for lack of a better word, that had absolute legal clarity was Bitcoin. But since the Ethereum ETFs have been approved in principle, it's sort of muddied the waters. It's difficult to understand how effectively a company with founders, a marketing team, a pre-mine, a changing rule set can be considered a commodity. It's difficult. In my mind, my tiny little pea-sized legal brain. But be that as it may, I hope to have a lawyer on the pod very soon who can help unpack that issue. So let's bypass that whole ETF because I don't think that it's actually based in reality. As far as I can tell, it's purely political. We are in an election year. And so everything needs to be looked at through that lens. There are something like 50 million crypto holders, and it feels like Gary Gensler at the SEC got a tap on the shoulder and said, listen, boy, you're not in charge. Let's change this. He's been going on and on and on how all of these so-called cryptos is to come and register, and then he changed his tune. But anyway, that's politics. That's people. I like Bitcoin. It's a set of rules and not rulers. Crypto, a set of rulers with rules that can change. So let's start at the beginning. So what I actually want you to achieve here, I'd like you to get a framework. I am not in the business of prescribing what people do with their money. I don't care. It doesn't make a difference to me. If you gamble, if you invest, if you save, if you don't, if you consume, it's irrelevant. It's truly irrelevant to me. And I don't say that in like a harsh, critical way. It's just, I believe in ultimate freedom. People can decide what they do with their money. Money is a proxy for your stored energy and time. And so if you're going out there and you're slaving away at whatever job you're doing, you should be able to do whatever you want with your money. I say that, but there are some caveats because the caveat to me is that I'm not really in favor of people spending money on things where they're not offering their fully informed consent. If you don't know what you're getting into, it's hard to make a educated decision. As opposed to if you go to the pokies or if you go gambling, you pretty much are aware that you're not going to win like 99% of the time. The house always wins. It's just the way the game works. There wouldn't be casinos if people won more than the house, right? Obviously. So anyway, I say that little bit of caveat because that is just truly the Bitcoin ethic. It's like you do you, all right? Now, part of what makes me somewhat qualified to talk about this topic is twofold. Like the one is, and I've talked about this on the show before, I'm a qualified lawyer. I didn't practice. I don't like practicing law. I didn't want to practice law. I knew in 2 weeks I was not going to practice law, but it teaches you how to think. And it has helped me have a look at Bitcoin versus crypto. It was through that lens when I first saw Bitcoin that I could easily tell the difference between Bitcoin and everything else, just through that little legal brain of mine. However undeveloped in practice it may have been in real life, the training itself is so invaluable in terms of structuring arguments and thinking and putting together coherent and logical arguments. It's just excellent. And I wouldn't have changed that for anything. So that's the first thing. The second thing is I had the misfortune or fortune, you could say, of working in crypto for a couple of years. Now, crypto, I was working in crypto publications. So it was kind of a combination of media and crypto. And so I really got to see how the sausage was made. And once you've seen it, it's hard to unsee it. And the thing is, when I talk about crypto media in a negative way, I'm just talking about all media. Show me the incentives and I'll show you the outcome. That's not my quote, but it's well known. So the same applies in crypto media, and I'll sort of touch on that there. But let's start at the beginning with my friend Lyn Alden. She's not literally my friend. Perhaps we'll be friends one day. She's my macro hero. And she says, look, those that conflate Bitcoin and crypto don't understand either. And I don't think I could put it any better than that. So let's start with Bitcoin. What is Bitcoin? Now, there have been books written about this. People will go read the Bitcoin Standard, or maybe something more accessible like B is for Bitcoin, or The Price of Tomorrow, or Layered Money, or Inventing Bitcoin. Just pick a book. There's so many, and each of them tackle the question of what Bitcoin is in different ways. Some people go say, read the white paper, and I go, probably don't. It's pretty confusing to the average person. It didn't resonate with me when I read it the first time. So, what is Bitcoin? Well, I like to throw a few things at people, and one thing I find tends to resonate with them. Okay. So, the first thing I'd say is like it's a digital commodity. It's much like gold in the sense that it is scarce, it is fungible, it is divisible, etc., etc. But unlike gold, you can actually teleport it. So it's gold with wings. You can think of that. Exponential gold, as Urin Timmer would call it, Boyapati calls it gold that you can teleport. And so I look at it as just a commodity. It's no different to lumber and oil and pork bellies and soybeans. The fundamental thing here, though, is that there is this tether to reality. There's a cost of production, and that is energy. Another way to think about Bitcoin is as an apolitical, stateless, neutral, censorship resistant money native to the internet. You've got people in parts of the world like Iran and Afghanistan who, through no fault of their own, have no access to banking. And to the extent that they do, are stuck with their worthless fiat currency or their local currency because they cannot engage in foreign international markets. They can't save in dollars, which, although dollars have been decreasing in value since their creation, it is the cleanest shirt in a dirty laundry. The dollar is pretty much the national currency that people around the rest of the world want the most. And yet they can't get access to it because of sanctions. And so, in that sense, Bitcoin is peer to peer, apolitical, and stateless, and it cannot be stopped. When you had the truckers in Canada protesting, they had their bank accounts seized, and that can't happen with Bitcoin. It's truly all money. Another way to think about Bitcoin is as an open and permissionless network, or a protocol of value, you could say. Much like TCP/IP is for the internet and SMTP is for email, Bitcoin is just the protocol of value for the internet. And much like other things in the internet, we will see applications built on top of it. It will scale in layers. And that's where we've seen things like Lightning and side chains and all sorts of other things developing. And then finally, you can look at it as money that is a hedge against fiat currency debasement. Because it is fixed in supply and it's got a supply issuance policy that is fixed in stone, it is deflationary by nature in the sense that it tends to accrue value over time, as opposed to fiat currencies, which tend to debase over time. Whichever country you live in the world, your fiat currency is going down in Bitcoin terms. So there's a couple of important things to note. The first is that there is no central leadership or management team. There's no website. There's no marketing. There's no PR departments. There's no company there. There is no single entity that can influence the issuance and the supply. We know exactly how many Bitcoin are going to be created every 10 minutes or so. And we know the fixed supply cap is 21 million, and that's not going to change. We also know that there is no single entity that can change the rules. And importantly, and this is very critical when we think about Bitcoin as opposed to crypto, there was no pre-mine. Satoshi didn't get together with his mates and say, all right, let's create 100 Bitcoin. Let's allocate ourselves 30. Let's take 20 and go and sell them to other people at a slight discount. And then we'll release the final 50 to the market. And then eventually we can dump our Bitcoin on them. So there was never a pre-mine. They didn't issue themselves tokens. To the extent that Satoshi has tokens, those were actually mined. There was physical energy expended in order to receive those Bitcoins. And that is very different to what crypto is all about. And so this is really the position that has been taken by US regulators, who arguably are the most important in the world, the SEC and the CFTC. And I'd like to encourage people to go to Fidelity Investments' Bitcoin First piece. That particular article was one of the more useful articles early on in my journey, and they've subsequently written a follow-up to it, Why Bitcoin First Revisited. And I'd strongly recommend people have a look at that, because it shows you that from an institutional perspective, there is no second best. There's no institutions that are clamoring to get their hands on Doge or Cardano or Ethereum. It's very clear that the real money, the weight of capital that sits behind entities like Fidelity and BlackRock, see Bitcoin very differently from everything else. The bottom line here, to sort of belabor the point, is that Bitcoin is a digital commodity. It's money, as Samson Mow would say. And yet, crypto is something very, very different. So what is crypto? Crypto is best seen, in my view, as early stage technology companies. You could look at them as liquid venture capital equity tokens with 24/7 mark-to-market pricing and exit liquidity without the need for a product market fit. I'm of the opinion that they are unregistered securities. A security is a specific term that effectively refers to shares or an investment contract, and there is usually a bunch of requirements in order for you to be able to market an investment contract to the public, including disclosures, and you'd have to go and register that. But crypto doesn't do that. With crypto, as I said earlier, you've got the 24/7 mark-to-market pricing and 24/7 liquidity, meaning I can get a price every single minute of the day, and I can exit my position any single minute or second of the day. The other interesting thing about crypto is, despite having tried for many years now, they're trying to create something of value. They don't really have a product market fit. There's no there. They're not creating real companies. There's no real revenue. There's no use case or utility. So from my perspective, 99.99% are outright fraud, scams, and Ponzi's or pump and dumps. Now, this has generally been the position held by the regulators until Gary Gensler got tapped on the shoulder of late. But I think the point remains that the regulators still believe that the vast majority of cryptocurrencies are unregistered securities, and we're seeing a bunch of lawsuits playing out that over time, I think, will prove that exact point. All right. So if we're having to distinguish between Bitcoin and crypto, it's pretty simple in my mind. Bitcoin is a digital commodity and it's money, and crypto is really an early stage technology company. You can say, what's the problem with that? Who cares? Why do Bitcoiners get so upset about crypto? Is it because we're stealing some of their market share, or, raining on their parade? No. I think my position, and this is my personal view, is crypto promoters are akin to digital snake oil salesmen. They're selling the equivalent of blockchain penny stocks in companies that have no customers, no revenue, and no prospects of success. It's a game for insiders, as far as I'm concerned. It's unfair, it's unethical, and it's illegal. Why do I say that? I think there's two things here. There's information arbitrage and regulatory arbitrage. So let's talk about the first. Information arbitrage. What does that actually mean? They don't have any obligation to make disclosures because they are offering a token to the public with little to no disclosures. That prohibits you from being able to make an informed decision as a prospective investor. They know things that if you were to know, you may think twice about investing, but they don't disclose it. Why? Because they don't have to. The other thing is regulatory arbitrage. They are able to effectively create liquid venture capital tokens, and they're able to raise capital from anywhere in the world without any disclosures, once again. Now, if I was trying to raise let's call it $10 million to create a property fund in Australia, it's not going to get you many properties, but let's just, for the sake of argument, just go with it. I would have to get numerous licenses. I'd have to get a financial services license. I would have to get, go and work with professionals to get product disclosure statements. I'd have to go and get professional liability insurance. I'd probably going to have to register with a bunch of different bodies. Now, you might say, well, Bitcoiners, you guys are libertarians. You guys are freedom maximalists. Why would you want regulation? Well, I think the only time regulation becomes necessary and sensible is when it is there for consumer protection. We should not be welcoming or endorsing people from being able to deliberately mislead retail investors by omission or commission, as it were. Ultimately, I want to just see a level playing field. And if you disclose a whole bunch of information that is patently one-sided and shows that there is zero chance of success for your prospective project, then by all means, anyone who invests deserves to get wrecked. But that's not how it works today. So crypto is a panacea for venture capitalists. It's a venture capital playground. And this is something that I saw in my time working at a crypto publication or two. So this is how traditionally venture capital would work. Let's imagine you have a specialty in a certain area in technology. You'd make maybe 10 bets. Potentially one or two of those are going to be successful. The vast majority will just go to zero. They'll just go nowhere. That's the nature of early venture investing. Most of the time it doesn't work. But when it does work, it works well, sure. Now, to exit your position, there was quite a long time to liquidity. It would take you 5, 7, 10 years. You had to build something of value. You had to have revenue. You had to have customers. You had to have users. You had to have something there. There had to be a there. You can just have some fabricated thing that you printed out of thin air and then just try and, realize liquidity. You had to create a company. And you could either sell that to a larger company or you could IPO. Those are like the real only ways you could exit. The thing in crypto, though, is it solves that problem. And I'm going to give you the 7 steps to getting rich in crypto as a venture capitalist, and perhaps you will kind of see how it all works. So the first thing that you do is that developers will just create a token and invent some sort of problem. It's there to solve a problem, whatever the token is. It doesn't matter if it's real. It's a problem, real or perceived. The more emotive the problem is, the better. It doesn't even matter that these days whether or not you even try and pretend to solve a problem. I mean, there's coins that are worth hundreds of millions of dollars that are just jokes. And that just blows my mind. But either way, okay, so you create a token out of thin air. You allocate yourself a bunch in a pre-mine. You then go to venture capitalists and you say, this is what we're doing. This particular coin does X, Y, Z, and this is how it's going to change the world. The venture capitalists, because you're creating these tokens out of thin air, and they're not tethered to reality in the sense that you have to expend energy to create them. You just print them like digits on the screen. So you go, yeah, cool, I'll give you some. Give your venture capital partners discounted shares, as it were. So the guys at A16 and Z, they got Solana at 20 cents or 80 cents, something like that. And then you'll go to PR agencies and crypto publications, and they'll go and promote your token. And then perhaps you'll do some airdrops so that retail investors will get some for free and they'll get all excited. And then you'll take some of the funds that you received from the venture capital investment, and you will then go and pay crypto exchanges to list your token. And once your token is listed, you now have got X liquidity. And at that point, you can just strategically exit over time. You can make your own weather in the sense that you can literally just, by promoting certain stories and narratives in the crypto publications, and because you've printed something out of thin air and got money for it, you're actually able to use that money to buy publicity, to pretend like you've got some sort of exciting thing happening with your crypto. That inflates the bags of those who are holding them. Typically, the guys who created it in the first place will have the biggest bags. And then you're in a position to rug people. So it's really like a little pump and dump in that sense. It's not like a unique value proposition. It's not something new. People have been doing this forever with like penny stocks and all that kind of thing. I mean, this is what the Wolf of Wall Street was all about. The only difference is it's so much easier and faster and quicker in crypto. It can all be done under the guise of innovation and things like that. Now, the concern, just for those who don't quite sort of see it yet, is with crypto, you can effectively do a IPO without ever having created anything of value. It's like literally me just going to the New York Stock Exchange and going, I'm listing a company, it's called DW Money Investments. It's going to be the biggest investment company on earth, challenging Warren Buffett's Berkshire Hathaway. Let's go. I want to raise money. You never have to create anything of value. There's no company, there's nothing like that. But that's what you can do with crypto. You can literally just have an ICO, which is the equivalent of an IPO. There's no compliance with capital market regulations, so you don't actually have to make any disclosures. There's a short time to liquidity, so there is fundamentally a conflict of interest between the developers, as well as the early venture capital investors and retail investors, because they're last in line and they're usually the ones stuck with the bags. And because crypto works that way, you can manipulate the price by adjusting the rules with supply, issuance, anything you like. You can effectively print your own money. And in doing so, retail investors get wrecked. That's just the beginning of it. I mean, it's littered with false advertising and marketing. The reality is like blockchain is not needed for pretty much anything other than money. It's just a slow distributed database. Many of the blockchains are so big and bloated, the likes of Solana, that they have to run on AWS web servers or Azure because people can't run these things at home. And so they're highly centralized. And so they decentralize the name alone. That's what we would say in Bitcoin, Dino. If you can't run a node that is a full copy of the blockchain at home, then it is not decentralized. Otherwise, you may as well just be running it on a cloud server with Google or whoever. And so, for the most part, it's just littered with false advertising and marketing, false promises, and it's just one giant red flag. Crypto is really, from my perspective, a game for insiders, and it's pretty much always at the expense of retail investors. It's broadly categorized in my mind as solutionism. They are just solutions desperately in search of a problem. They first like conceive a token, and then you think about the problem you want to solve. And if you can't build some sort of token into your company, then you've got to go back to the drawing board, because that's what allows you to have exit liquidity. It's really just Fiat 2.0, because most of them use proof of stake as the consensus mechanism. And in that version of the consensus mechanism, the rich just get richer. The more you own, the bigger your stake in the protocol. So I don't really see what problem it solves. And, fundamentally, it's just not Bitcoin. Now, I do want to be reasonable and say that there are some exceptions. Things are changing rapidly, but the vast majority of liquidity today for stablecoins sits with shitcoins like Tron. Less so with Ether these days. It's a race to the bottom with shitcoins because all they need to do is be as fast as humanly possible. The decentralization piece is absolutely not necessary, but we have to be honest with ourselves that the average person in a third world country cannot afford to ride the volatility of Bitcoin. If they can be persuaded to chuck a portion of their savings that they don't need for 4 years plus into Bitcoin, that's always the first prize. But if they can just get access to something that looks like a dollar that can preserve its value, notwithstanding the counterparty risk of things like USDT and USDC and those kind of things, we have to acknowledge that there is some value in that. Now, this is changing, and I don't know enough about it. I'll be completely honest. But there are things like stable sats, and there are things like stable coins being built on top of Bitcoin that don't have widespread adoption, but slowly but surely, that's where I think things will go over a long enough time horizon. So in the interest of being charitable, I thought I would mention that. The bottom line is, and I think I want to leave you with this message, know what you own and why you own it. Bitcoin's value proposition is that is a digital store of value and censorship resistant money. And from my perspective, it's got a total addressable market north of 100 trillion. There's like $900 trillion worth of assets out there. And I think that Bitcoin within the next 20 years will be north of 100 trillion comfortably. Individuals, corporations, nation states are all at different stages of adopting Bitcoin. The sooner you adopt Bitcoin, the greater advantage you have to benefit. When I think about crypto, I don't know what problem it fundamentally solves. When I speak to people in crypto or crypto proponents, I can't see what they fundamentally are trying to solve. They are unable to articulate a proper use case. Bitcoin's use case is that it provides you with an inflation hedge against monetary debasement, and that the lowest return you've ever had over 4 years is 100%. That's the use case, and no one can stop it. It's decentralized and censorship resistant. So those two qualities make it an absolute home run. And that's where I think so much of its value is derived. But is that going to happen with crypto? Absolutely not. I can't see where the value is long term. Of course, as long as there's Bitcoin, there will always be shitcoins because there are opportunities for people to enrich themselves. The latest craze is just the meme coins and the joke coins and the stuff that honestly just has no value for no value's sake. It's hilarious. This is just end of empire stuff. I can't see this stuff lasting in the fullness of time. It is akin to the dot-com bubble time where, all you needed to do to literally go and raise money and list your company on the stock exchange was, just buy a domain, and you didn't even have to have a functional business. And I think that's kind of where we are now with crypto. These things just don't have a point. I mean, just the other day, there was Caitlyn Jenner coin. It went up like 50,000% in a day. And, Caitlyn Jenner honestly said, this thing's got value. And like, yeah, sure. If you could print your own money, wouldn't it be nice? So that's all for today, friends. I hope you found that better. In the words of my other friend who I've yet to meet, Michael Gigachad Saylor, there is no second